Welcome back to the Tuesday Target audio brief. We are at week 4 of 52, and man, the headlines this week are completely obsessed with this Greenland drama. It looks like a diplomatic disaster.
It does on the surface. But if you read this week's letter, Yuri calls it Negotiation 101. It's not a blunder, it's a leverage play. You create chaos, you demand the impossible, like buying the North Pole, and then you settle for what you really wanted all along, the mineral rights.
So it's a bluff to secure assets on the cheap. But the newsletter points out a massive risk here. Washington is trying to bully the banker.
Exactly. Washington seems to have forgotten that Europe sits on $8 trillion of U.S. assets.
8 trillion?
8 trillion. Everyone is worried about tariffs on French wine. That's a distraction. The real nuclear option isn't a trade war. It's a capital war. If Brussels gets tired of the pressure and rotates out of U.S. treasuries, they could suffocate American liquidity overnight.
And it's not just Europe. Japan looks like it's cracking too.
That's the other shoe dropping. Japanese politicians are promising massive spending sprees just as their bond market is breaking. Yields in Tokyo are hitting record highs. So you have the world's two biggest creditors, Europe and Japan, under huge pressure to bring their cash home. That is the ultimate unpriced risk.
Speaking of risks, let's talk about the domestic economy. We saw a 5% GDP print recently. That sounds fantastic. Why does the letter call it a mirage?
Because algorithms read headlines, but we need to read the footnotes. That 5% number was heavily distorted by a surge in precious metals exports.
Wait, so we aren't producing more cars or software? We're just shipping gold bars?
Kind of. It's capital flight masquerading as productivity. If you strip out those gold flows, the real economy is operating near stall speed.
That weakness seems to be hiding in the small caps too. The Russell 2000 is rallying on this affordability narrative.
It's a value trap. Retail tourists are buying the hype, but institutional flows are deeply negative. Smart money is using this rally to exit zombie companies. Firms that simply cannot survive refinancing at these rates. When price goes up but smart money leaves, that usually ends violently.
And we can't count on the Fed to save them, can we?
Count on it less. The letter argues the era of the independent Fed is ending, with the DOJ investigating Powell and the White House interviewing asset managers for the chair role. Monetary policy is becoming just another arm of election strategy.
Let's hit the contrarian section. Yuri had a hot take on China.
Yeah, the China is uninvestable crowd is missing the rotation. Their property sector is dead, sure, but the state is funneling everything into hard tech, robotics, aerospace, AI. Look at DeepSeek. They are disrupting software moats at a fraction of Western costs. The old economy is dying to finance a dangerous new competitor.
And in energy?
Uranium. Germany finally admitted their nuclear exit was a strategic mistake. Physics finally beat politics. That puts a structural floor under the price. It's a renaissance.
Okay, let's wrap it up with the tactic for this tape. The newsletter highlights the Russell 2000, IWM, but not for direction.
Well, in a way we are, just both directions. We are betting on the explosion. Volatility is at 5-year lows, but the market is coiled tight. The trade is owning the gamma. You structure a trade that wins if the move is violent in either direction.
Rent the upside, don't own the bubble.
Exactly. And for the full chart on that trade, plus the details on the Elite Trader plan, check the links in the description below.
Don't guess. Do the work. Thanks for listening to Tuesday Target.
Catch you next week.